Welcome to our deep dive. Today, we're digging into something that's definitely stirred up some conversation. ARK invests really high price target for Tesla stock.
Yeah, if you all Tesla, you've probably seen ARK's numbers. They tend to stand out.
They really do. So we've been looking through the analyses, the summaries of ARK's research here, and our mission, basically, is to break down their thinking.
To really get under the hood of why they're so bullish.
Exactly. We want to pinpoint the core driver, like the biggest single reason behind this, well, pretty bold forecast for Tesla's value down the road.
And the interesting part, right from the start, is that according to ARK's view, it's not primarily about selling more electric cars.
Not at all, which might surprise some people. They see something else as potentially way more valuable. Okay, so let's kick off with those headline numbers from ARK, based on what we reviewed. Their average price target for Tesla in 2029, a staggering $2,600 per share.
Wow, and they have ranges too, right?
They do. A bullish case, potentially hitting $3,100. And even their more cautious, bearish scenario still lands at $2,000 a share.
So let's put that into perspective. The sources mentioned recent prices maybe in the $200 to $300 range, give or take.
Right.
Hitting $2,600.
Right.
That's suggesting, what, a potential 7, maybe 10 times increase from those levels?
It's huge.
A target like that really signals ARK sees Tesla as fundamentally something very different than just a car maker.
And that brings us right to the absolute core of it. The main finding from these sources, the thing that really defines ARK's whole position here.
Okay.
Their analysis suggests that a massive chunk, we're talking roughly 80% to maybe even 90% of Tesla's entire projected value by 2029 is expected to come from just one specific business line.
One area driving almost all the future value. Okay, I'm listening.
Yeah.
And that area is robotaxi.
Robotaxis. Autonomous driving taxi services.
Right. So what's really fascinating, and this is key, is that ARK isn't primarily basing this huge valuation on, say, how many Model Ys Tesla sells next year.
Or even their overall EV market share, necessarily.
Exactly. They're looking at Tesla and seeing, first and foremost, a future company built around self-driving mobility as a platform.
Okay, hold on. Robotaxis making up 80, maybe 90% of the value?
Yeah.
That's an enormous bet on one thing. What is it about these robotaxis that makes them that valuable in ARK's model?
Well, the absolute key difference, the thing that changes the game according to ARK, is profitability. Margins.
Okay.
They see robotaxis not as selling hardware, but as selling a software-based service, and potentially a very high margin service.
So different economics entirely.
Completely. Think about a regular taxi or, an Uber ride today. What's the biggest cost?
The driver?
The human driver, yeah. Take that cost out with autonomy, and suddenly your cost per ride or cost per mile can drop dramatically.
Right, and the sources we looked at really hammer this point home. They contrast the margins. Typical EV sales margins maybe somewhere in the, 15% to 25% range?
Yeah, something like that. Good margins for automotive generally.
But robotaxi service margins, ARK is projecting those could be like 80% or maybe even higher?
80% plus. That's software-like margins. It's a fundamental shift or a really dramatic change in the potential profit model for the whole company.
Okay, so super high margins. What about the scale?
That's the other part of the equation. You combine those high margins with potentially massive scale. ARK's projections talk about maybe 5 million robotaxis operating globally by 2030.
5 million.
And they estimate each one of those cars could potentially generate something like $30,000 a year in revenue.
Okay, wow. So you multiply that out.
We multiply that out, especially with those 80% plus margins. You can see how that revenue, and particularly profit, could potentially just dwarf the money made from actually selling the cars themselves.
And there's an efficiency angle too, right? Feeding into those margins. It's not just removing the driver.
Exactly. Robotaxis would also benefit from the lower operating costs of electric vehicles compared to gasoline cars. ARK estimates EVs cost about a third as much per mile for energy, maintenance, that kind of thing.
Right.
So ARK did this cost per mile analysis that's pretty interesting. They estimate robotaxi costs could potentially get down to like $0.25 to $0.40 per mile. 25
to 40 cents a mile. Compared to what for a traditional taxi?
Compared to maybe around $2 per mile for a traditional human-driven service.
Okay, so that's a huge cost advantage. That suggests they could potentially offer much lower prices too, really disrupting.
That's the implication, yeah. Serious disruptive pricing power in the whole transportation market if they can achieve those costs and scale it up.
Okay, so the potential looks enormous on paper. Huge market, incredible margins, big cost advantages. But that's the potential. The multi-trillion-dollar question is, can Tesla actually pull this off?
Right.
What makes ARK believe Tesla is the one to, not just compete, but actually lead this whole robo-taxi race?
Well, ARK's analysis points to a few key areas where they see Tesla having some pretty distinct advantages.
Okay.
First and foremost, they really emphasize Tesla's lead, or perceived lead, in the full self-driving technology itself, the FSD.
The software.
The software, exactly. ARK argues Tesla's ahead, mainly because of just the sheer volume of real-world driving data they've gathered.
From all the cars already on the road using FSD beta.
Precisely.
Yeah.
Millions of cars, billions of miles. That data is like gold for training and improving these AI systems. They see that as a massive moat.
Okay. Data advantage. What else?
Second, they talk about hardware integration. Tesla doesn't just buy off-the-shelf sensors and chips, right? They design their own cameras, their own custom silicon, like the Dojo supercomputer project.
Right, they build it all in-house, basically.
Yeah, and they integrate it tightly with the vehicle design right from the start. ARK sees this, creating this really strong synergy between the software and the hardware, optimized specifically for autonomy.
So they control more of the stack, unlike companies maybe patching together third-party bits.
That's the idea. And that leads to the third point. Vertical integration more broadly.
Meaning?
Meaning they control manufacturing, the software development, and they own the charging network, the superchargers.
Ah.
ARK believes this whole package deal allows Tesla to potentially iterate faster, scale quicker, and optimize the entire robotaxi service more effectively than competitors who might rely on partners for charging or manufacturing or core tech.
So it's less like just selling a product and more like building this whole ecosystem.
Exactly. It starts to look less like a traditional automaker and more like building and operating a whole platform economy. Kind of like an Uber or an Airbnb maybe, but with much deeper control over the actual physical assets and infrastructure.
Okay, so summing up ARK's view, it's this mix of, one, these potentially amazing market dynamics, huge size, high margins, and two, Tesla's specific advantages in FSD data, custom hardware, and that vertical integration. That's the foundation for their really bullish robotaxi case.
That's the core of it, yeah. So what does all this actually mean for you if you're, watching Tesla, maybe thinking about investing or just trying to understand where it might be going?
Right, the takeaway.
Well, the opportunity, if ARK is right, if this plays out, it's genuinely massive. We're talking about disrupting the global transportation market, which is worth trillions. Capturing a big slice of a future autonomous chunk of that market could create enormous value.
It's clearly a long-term vision they're buying into.
Oh, absolutely. The sources make it clear ARK's perspective is very much long-term. It's a bet on Tesla's vision, yes, but also critically on their ability to execute on some really, really difficult technology and scaling challenges.
And it's definitely not without risks. I mean, ARK models different scenarios, so they acknowledge risks, even if they lean optimistic.
For sure. The risks are substantial, and anyone looking at this space knows them well. Competition is fierce.
Right. It's not just other car companies. You've got big tech, specialized AV startup.
Exactly. Then there's regulation. Getting approval for widespread, truly driverless operation, that's a huge hurdle. It's complex, varies everywhere, cities, states, countries. You need safety validation, public trust.
It's not a simple switch you just flip on.
Not at all. And, maybe most importantly, the core FSD technology itself still needs to prove it's fully mature, incredibly reliable, demonstrably safe for mass commercial deployment without a driver ready to take over.
The sources mention things like initial limited rollouts, which kind of underscores that it's going to be gradual, right?
Yes, very likely phased and cautious, especially at first. It won't be 0 to 60 overnight.
So thinking about potential timelines, like the sources suggest, the short term, say the next year or so, robo-taxis probably won't move the needle much on the stock price. Maybe even some caution with those first small rollouts.
That seems reasonable, yeah. Initial challenges, limited scale. The medium term, maybe looking out 1 to 3 years, that's where you might start seeing a more positive impact if the service expands significantly, if the tech proves itself more widely.
But the big prize, the thing that could actually justify those huge $2,600, $3,000 price targets from ARK, that's really a longer-term bet.
Definitely. That's the 3+ year horizon, where the potential lies if the business scales massively and if Tesla really does manage to capture a dominant share of this emerging high-margin mobility market. It's a lot of ifs.
Okay, so wrapping this deep dive up, the clear central takeaway from looking at ARK Invest's analysis is this. Their super bullish forecast for Tesla. It's overwhelmingly, fundamentally driven by the potential they see in the robotaxi business.
Yeah, they're not just valuing a car company anymore. They're valuing what they believe will become a high-margin, autonomous mobility platform.
So what, for you, the listener, is that this analysis really encourages, maybe even forces you to think about Tesla's future value very differently.
Right. It shifts the main focus, at least in ARK's view, away from just counting how many cars they sell each quarter.
Which is what Wall Street mostly focuses on now.
And toward the potential future value generated by autonomous miles driven as a service, bringing in that high-margin recurring revenue.
Yeah.
It's a completely different business model layered on top.
So here's a final thought to leave you with, building on that. Think about the broader implications here. If a company known primarily for making complex hardware, like cars, could potentially see the vast majority of its future value derived from a software and service layer, like robotaxis, what might that trend mean for other traditionally hardware-focused industries you follow?
That's a really interesting question. Where else could that software and service value unlock happen? Something to definitely mull over.